Nice. Hey guys, so I got a little bit of food poisoning last night, so I'm gonna just please bear with me. If I need to take a pause, that's what I'm doing, not contemplating about life or anything. Cool. So this talk is about DeFi Math 102, just a little step up from the things that you might be familiar with in DeFi. And particularly, we'll be talking about how to construct token derivatives, whichever one you want. So quick background is I used to work at an HFT at Hudson River Trading. So my background is a lot in thinking about market microstructure and not so much the macroeconomics, but that makes me really suitable to speak about how we design these small DeFi systems. Right now, I'm building Ethos Finance with two other people, and we specialize in creating these things called token derivatives, where you can think of it like this engine that you put in a token, and then you get out a separate payoff that is derived off of that token. So for example, I can put in normal BTC, and suddenly I might get like an option on BTC or a future on BTC. And those are the two basic ones, but we can go crazy with it. We can start guaranteeing token floor values, we can prevent liquidations, reduce volatility, really get some nasty stuff that maybe you've never even heard of unless you are in wealth management or are very wealthy yourselves. I don't know, maybe you are. I hope you are. So the reason that this is different than previous attempts at structured products is the previous attempts all use an off-chain underwriter and they bridge the asset over. And so users buy it from a vault, it's usually priced by a sophisticated underwriter, and that really means you're just getting adverse filled. Like from day one, you have negative expectancy, and that's not great. You have lockups, you have an expiry, and you have manager risk. Like all these things make vaults a terrible experience. What happens now if you derive your structured product entirely on chain, your counterparty are DeFi native money markets, DeFi native AMMs. Anyone can build, mint, and use it within seconds. There's no one you have to talk to, nothing you have to worry about. There's no lockups, no managers, one smart contract transaction, and you're good. Cool. So just to be clear, this is a 102 talk, which means I won't go through the, it won't be too advanced. There's no, you don't need to worry about finance or whatever background there is. It's mostly just gonna be pictures, which is great, everyone loves pictures. There is no pricing information here because honestly, once you get into stochastic calculus, it's very hard to come back. And that's just not what this talk is trying to do. But feel free to talk to me about it afterwards. And especially once you get more advanced, the theory and reality really breaks down. So I didn't want to talk about things that have a lot of qualifications to it. Rest assured, everything we go over today is 100% true. You can rely on it to build your own protocol, to invest, whatever. It won't be too basic at the same time. I think Josh did a really good job covering AMMs, so I'll be super quick about that. There's plenty of DeFi users here. There's so much existing material. I'll do a super fast recap, like the fastest you've ever seen. And I can't do 101 because Taipei already has a 101, Like, who can compete with that? So today's lineup, we're going to be talking about 5 techniques you can do to build a structured product entirely on-chain. What this new version of structured products is going to look like. They're going to be rotation, reflection, composition, scaling, and integrations. And with each of them, you have a different type of payoff we can make. So before we begin, here's my quick recap of AMMs and LPs. It doesn't matter about the market making. It doesn't matter about the range. Forget all of that. The simplest explanation of an LP, a liquidity provision position, is you sell the token upside for yield. That's it. Over in the future, we might design new AMMs, like Josh has different curves. All of them have one fundamental property, and that is you are selling your upside for yield. What this looks like is, here's a regular token payoff. If the price goes up, you profit. The price goes down, you lose. And once you LP, you get capped profit on the upside, and you still have your unlimited downside potential. So that's no fun because you're missing out on a lot of these profits. And we'll be talking about how to fix exactly those things. Before we move on from this, though, I do want to mention one property, that the capped upside comes from the negative curvature here, and we'll call that concavity. And one fundamental property of all finance, doesn't matter if it's DeFi or TradFi, is the moment you have negative concavity, you earn fees. Negative gamma, they might call it a billion different things, but there is fee earning or yield whenever you have negative curvature. So one very natural question is, we have this LP position, can we kind of flip the side, right? Maybe I think the token is gonna go up, so why am I selling? Or maybe I think the token is gonna go down, so I don't want that downside risk. So instead, let me rotate the position so I only have upside risk and no losses when the price goes down. Very natural position. And the way you do that is just with simply a short. That once we short the, in this example, ETH token, into USDC, the combination of the two gives us this type of payoff. We still make fees in the same range, but we just have a slightly different exposure. And we can also short everything in between one end or the other, and so we can make a delta neutral position just by shorting less. Nothing crazy here. The one caveat, though, is you don't want to overshort. In this scenario, we shorted the 90-degree rotation by understanding the Uniswap v3 paper. I don't want to get into that, but it's a pretty straightforward formula. Once you overshort past 90 degrees, though, the short dominates the position, and you pretty much botch whatever you were trying to do before, and you just essentially have a short position. So yeah, that's a simple technique of rotation, and it gets more exciting once we start talking about reflection. Now, how do we create the opposing curve, right? Maybe you're just sick of downsides. Why do we always have to have a downside with LP positions? What if I just want a position that is all upside? Safe on one end and only profits on the other. And mathematically, there's no reason you can't do that, right? Anything we create in code means anything we can describe with math, and clearly we can describe this with math. So how do we do this? Well, the answer is pretty simple, actually. We just have to reflect over the intermediary line. And so you can just draw the line and say, I want to short the LP position in return for these assets that are denominated by the line. And all of a sudden, I have my liquidity taking position that is only positive exposure. This is fantastic. And it doesn't have to be that line in the middle. You can use different lines, and so maybe you want something with more of a negative exposure. And with all of these, there is some floor value, so why don't we just subtract that floor value, add in some more capital efficiency, and voila, we suddenly have these options payoffs. And so we've already arrived at a pretty big step. You don't need SSOVs, you don't need off-chain underwriters, you don't need a limit order book to create options in DeFi. You just have to do a bit of math, and boom, you have your option payoff. The downside is, nothing comes for free. If you want all upside, there has to be a downside. And the downside really just comes from shorting that LP position. Because unlike shorting a token this time, shorting a position means you have to do the entire opposite. So whenever the LP position would earn fees, you have to pay fees. And that's a pretty fair trade-off, because I'm sure there's more than one person here who's LP'd for like 6 months, and the yield was definitely not worth the impermanent loss you got. And what if you could just take the opposite position, right? It's like that Wall Street bets thing. I keep losing money, well, just do the opposite of whatever you're doing. Literally that. So if you ever feel like the yield is too low, heck, take a liquidity taking position. And once we start combining this reflection and rotation technique, we can start doing some crazier things. I narrowed down the market making range to be really small, right at the current price, rotated it by 22 degrees, and all of a sudden you have a bidirectional perp, meaning whichever way the price moves, you profit. The exact same way a perp would, but now you pay a slightly higher funding rate as long as you're sitting in the middle. So that's a pretty good deal when you're just trying to bet on volatility and you have no idea which way the price is going to move. Probably like right now. And it gets even crazier once we start adding cross margin into it. This is really where we start touching on insanity, because we have all these positions before and we can combine them into insane things. This is just a random position I decided to create because I could. And Mr. Bones' Wild Ride is made by all these different positions underneath it. And the way to construct this thing, the way I went about it was I just thought about, where do I want positive and negative curvature? That is where I'm going to create my market making, market taking ranges. And then on either end, what do I want the first derivative to look like? Depending on that, I can short or rotate accordingly. And boom, within 5 positions, I've created a roller coaster of a payoff. But you can make more useful things. It doesn't have to just be like meme payoffs or whatever. If I want to fix LPing, one of the worst parts of liquidity providing Uniswap v3 is that once you go out of range, you stop earning fees, but you still continue your losses, right? If the token is just going down, you come back in a week and you're eating all of those losses without earning anything. So a very natural thing is the moment I go out of range, let me hedge out my position, not worry about it. I can come back in a month. I can come back in a year. There's no risk to me. So it's a much more user-friendly version to LP. And we don't have to stop there. We can make a delta-neutral version of this, applying the same techniques we already have. Heck, we can even start doing more degen things where we're like, I want to make money in the extremes. I don't even just want to hedge. And we can ramp up the two liquidity taking positions on either end as much as we like. We can compose it however we like. Really, at this point, the possibilities are endless. Literally, whatever type of curve you want to create, doable entirely on chain, no permissions needed. Forget about TradFi, we don't need them. My personal favorite, though, is actually this one, which is the token converging LP. This construction makes it so that in the short term, if you're just worried about the price right now and you want to earn yield right now, you can. It sells curvature at the current price. But if you don't worry about the token going up 1.5 or 1.7, you're holding until that token goes to 2x to 10x. The liquidity taking is structured in a way such that you reconverge back to the tokens line if it ever 2x's to 10x's. And honestly, that's like what a lot of people are holding for. So in a way, this is kind of what people originally thought LPing was going to be. I can just hold a token and earn yield on top of it. I don't have to think about impermanent loss. Great, so that's composition. What we did in composition was create a really safe way to LP. But let's be honest, like degens don't get out of bed for safety. No one is like, I want to be safe with my investments, let me go to DeFi, right? They want something exciting. And so how do we turn this into something exciting? And obviously the answer is leverage. The answer is always leverage. But what is leverage really doing? It is scaling our position. So the first thing we're going to do is notice we have a floor price. And that floor price means our position will never go below that value. So this is kind of capital inefficient, right? If the floor is that high, what if I just deposit less to translate the whole thing down, just like we did with those option payoffs? And we can. In this scenario, we're not just depositing less, we're actually depositing the whole LP position and then borrowing, which is effectively the same thing. And we suddenly have a way more capital efficient way to LP. But it's not just capital efficiency, because we can scale this baby up to roughly 300x LP, depending on the pair. It just comes down to what is the granularity of your AMM. And if your granularity is small enough, you can just keep raising that leverage. And at 300x LP, like, you can beat impermanent loss by just LPing for a single day, right? If you think the price is not because like Fed Powell isn't talking today, you're just like adding liquidity today and nowhere else. And you've already earned a year's worth of yield just by doing that. So we're super happy with this. We think this is like the most degenerate way to liquidity provide. We can go even more insane though. And that's not just with payoffs. Once we start integrating this with other protocols, we get some really beautiful properties in those other protocols. For example, if we want to add this to a borrow lending market, we can create liquidation-free borrow lending. With a single button, you can say, hey, I think volatility is too high. Open up all the positions, all the convex positions I need to make sure I never get liquidated. I can borrow and lend any token as collateral for any other token because, again, I can just use these convex positions to hedge that divergence risk. So like this utterly changes both the payoffs that we're interested in and the other protocols. Like we could have non-liquidating perps, and the list really goes on. Like these are just some of the things I thought about, but I'm sure like there are plenty of things I haven't thought about. And the list goes on and on. Digitals, roulette wheels, LST convertibles. Yeah, I won't even try to read all of them. But what really excites me is the implication of this. Like from a broader perspective, looking at the forest, for the first time in history, it's not a TradFi institution that is underwriting something for DeFi, right? Every time DeFi tries to do something more advanced, we have to go to TradFi and be like, hey, can you help us out with this? All of a sudden, it's not that TradFi and DeFi are creating the same structured products on par with each other. It's that DeFi creates more advanced, more flexible, more assets than TradFi. Like all of a sudden, the best place to go if you ever want a structured product is DeFi, right? And I don't think you can say that about a lot of markets. And the beauty of it is it just comes from math. One of my friends works at Goldman Sachs, and his desk regularly underwrites about $2 billion worth of structured products every month. And the only thing they're really doing is floor valued SPY, floor valued NVIDIA, floor valued Tesla. And that is so easy to make on chain. If you ever had an RWA for any of those things, you don't have to go through an account manager. You don't pay them commission. You don't pay fees. You don't make 6 phone calls just to make sure you have the approvals to do it. One transaction, boom. Cool. So this is not just theoretical. We actually went out and built these things. And today is the first day we started uploading a lot of this onto testnet. And so you could go yourself to, oh no, where's my mouse? Bear with me as I struggle to, yeah. So what we can do is you can go to Ethos right now and get your IL hedge position, your real hedge position. It feels a lot like Uniswap. And we really just wanted to make a very degenerate version of Uniswap. Don't worry, the leverage bar is right here. For this pool, you can only go up to 20, but it depends on the pool. Maybe we'll redeploy at some time. And you can see that once you jack up this leverage, let's say to 10, you get 210 APR instead of whatever. But of course, the IL risk is higher. So nothing comes from free. We're not trying to make any shticks. We're just trying to do a bunch of math and the flexibility that comes with it. Cool. This is permissioned right now, but you can go mint yourself test tokens today just on the website, testnet.ethos.fi. And I want to be clear that it's not as simple as just doing these equations. We had a lot more to solve, and honestly, these were much harder than the things that I talked about today. And so unfortunately, we don't have time to go through it. But you have to think about ideas of what is the fair trading fee rate, and that gives you an implied volatility premium. The hardest one is by far, how do you implement a fair liquidity borrowing rate? Like, what is the corresponding time premium you can derive from options and translate that over into what liquidity taking should be. Honestly, everyone knows the right answer to that. Everyone in finance knows the right answer to that because you can create a box spread and you would know what the implied lending rate of these things should be. But what is a box spread in DeFi and how do you implement that corresponding interest rate? Finally, we have to make some really safe and user-centric cross-margining. That is not a simple deal at all. And how do we present it in such a way that, most of DeFi is not as experienced as you guys. So how do we keep it simple and relatable? Cool. So we're nearing the end. What else is there to solve? We don't want to pretend that we have all the answers. There's still a lot more to do with just the math for DeFi is utterly unsolved. Continuous expiry offerings, how do I recover the expiry ideas from options? Because those are indeed useful in a lot of scenarios. How do you make conditional liquidity providing, like only providing when the yield is sufficiently high? How do we butterfly the yield curve? The list really goes on. And if you're interested in these things or interested about building those things, please talk to us. So finally, we are Ethos Finance. We launched a lot of things on our testnet deploy today. It is still private for now, so you should follow our Twitter, go on our website, join our Discord, and keep in touch for updates. We are now raising a seed, and so if you're a builder, developer, DeFi user, investor, come talk to us. Cool. I hope that was helpful. Any questions?
If no questions, you do have their Twitter, and you can also find Terence at after his talk, I guess. Thank you very much.
I guess I will mention that this also happens to be the proof of why, the composition aspect is the proof of why the Uni v3 curve, in my opinion, is all you need, because every other payoff curve can be replicated as just a combination of Uni v3 positions. So I think that's an interesting property, but there is value to having the entire curve be preset for you so that users don't have to think about it. Yeah, it's an interesting homomorphism between all yield curves. Cool.
Thank you.